The basic concept of a double deduction in tax law is nothing new. It's been around for quite a while. And it's basically turns on this principle that you can claim a deduction in two different ways. One is as a taxpayer and effectively another as an employee. And I'll give you an example of this. If you, say, incur an expense for an income producing purpose, tax law generally says that is deductible. You can claim that expense against your income, no problem. But you're doing that as an individual, say in this case as a taxpayer individual. But as a taxpayer individual, you can also be an employee of a company or a trust or whatever. Now, that relationship also allows you to salary package arrangements. That is, you can effectively reduce your tax by having your employer pay an expense for you. Where the double deduction kicks in is that there are quite a few occasions where you can salary package an expense that an employer effectively has paid for you and therefore save tax on, not deriving that income and paying tax on it. And at the same time, claim that expense as a tax deduction, the so-called double dip. Now this is really useful, but it's got to be organised carefully, and you've got to sort of think through and plan out both your salary packaging and the costs you incur. The example in the article deals with that of a rental property, which is fairly straightforward. If you think about it, you own a rental property and you incur costs for that property. Now, these sort of concessions don't apply to all expenses. They basically only apply to what you might describe as plant and equipment, things that are subject effectively to depreciation, but for one reason or another are an immediate tax deduction. And there are rules that allow this. For example, if you've got a rental property and you buy an item of plant for that property, say a light fitting, that costs less than $300, you can write it off immediately. It's this principle that allows the double deduction. I own a rental, I buy something that costs less than $300, which is a depreciable item, I can write that off immediately. At the same time, if I'm employed by a company and my employer salary packages that same expense, that same outlay, I can effectively not pay tax on the income that I would have otherwise have derived. Now this is a salary packaging principle that's beyond of the talk at the moment, but it works because you don't pay tax on income that your employer hasn't paid you because they paid the expense direct instead, and on top of that you then get a deduction for paying the expense yourself anyway. So effectively you get this so-called double dip. Now for rental properties this can be a very powerful tool. It can save you quite a bit of money. Another useful aspect of this is that if you buy a rental property and you get a quantity surveyor's report, they often identify a great many expenses, depreciable so-called items, less than $300, that you can write off in one hit, and then your employer can package those costs, and then you effectively get a double deduction for what could be quite a few expenses. This concept gets even more interesting if you are an employee but also run a small part-time business. If you are effectively a small business entity and you qualify for certain concessions, and one of those is that if an item of plant costs less than $1,000, you can write it off in one hit. Very nice. The same principle then applies, technically speaking. If you're also employed, your employer could then salary package that same item and you effectively will get a double deduction. And you can see, depending on your tax rate, the amount of tax you can save is quite considerable. This doesn't, however, apply to all type of expenses, and the key point again is to reiterate that it's about depreciable items, A. B, you must make sure you've got an effective salary packaged arrangement with your employer. Now your employer doesn't necessarily have to be a traditional third-party employer. You could be running your own company or trust and still be an employee of that entity. So this sort of tax planning is possible for taxpayers who are effectively self-employed through directorships or being trustees of their own business trusts or companies. The tax planning works very well, but like any tax planning, attention to detail is important. Thank you.